take a look at technicals, and we can go anywhere in terms of technicals, because I didn't say technicals of what. Katie Stockton is Fairlead Strategies founder and managing partner and a CNBC contributor. I'd like to talk about a lot of different things, Kate, like even gold. But let's talk first about Bitcoin, because 59,000 for months has been something that you said was important. And this is how many times have we seen it tests 59?
Yeah, this is probably the third test.
Is it going to hold? And if it doesn't, I was talking the other day about if it didn't hold, and it wasn't you, I don't think, but someone told me some terrible number about where it could go if it broke 59.
It's not to say the bottom drops out, but the next support, the next major support, we're talking low 40s.
I heard even worse. I heard someone say even worse than that.
That can't be unheard of for Bitcoin, knowing the volatility. It's down about 30% after failing right at that 200-day moving average. It was almost perfect right there as resistance. So that continues to be resistance. It's obviously trending lower. The good news for Bitcoin traders or investors is that we have a long-term oversold condition, and it's been in place for a duration at which it usually starts to impact the chart. So we're looking for stabilization. Ideally, it does happen in this range because it is a key Fibonacci retracement level below which oftentimes a full retracement happens. So we're hoping to see it. 60,000 is also a key level as well.
Okay, so it's down 60% from the high, or 50 and change?
Close to that.
So not 80. And other drawdowns before it was as institutionally accepted and there were no ETFs. So people, a lot of people, the bulls that we have on, say this might not be a full drawdown like we've seen in the past, and we could be near something now. You think there's any merit to that argument?
I think we can still see those 75, 80% drawdowns, but as a technician, I almost see the volatility as opportunity. And when we do have those big drawdowns, which we can avoid using those trend following gauges, then, of course, you have an opportunity to ride the relief rally. And those can be just equally violent, as you know. So I'm a Bitcoin bull from a very, very long-term perspective. I'm not really on board with these 4-year cycles. We don't have enough of them to feel confident in them. But I'm always looking for signs of downside exhaustion for that opportunity.
And it's just human nature. You could use this in any market, but it's at 125. It's like, oh my God, it's too high. I can't buy it. I'd love to buy it. I can't buy it at 125. I would love it. At 60, it's like, I'm not buying that.
It's market psychology.
So even
at work.
People that wanted to buy it at 125 are afraid to buy it at 60.
It's really hard to buy it into weakness, but it is often the right thing to do. We like to see a little convincing shift in momentum before adding exposure. And because support is being tested so hard, ideally we see even a couple, 3 weeks of stabilization here before feeling convinced it's holding.
Right. You had to be surprised by the move in the S&P since last time you were on.
Yeah, without question. I mean, we saw.
I even said technical analysis is only so good. You track momentum. You do the. But last time you were on, I think we were at 6,500 or so, and you told me, and I didn't believe you, and that's why I remember it. But you told me, yeah, we need more work to do on the downside. Next thing you know, 2 months we're up 20%.
Yeah, it was really surprising because we saw whipsaws in our monthly indicators, which almost never happens. So I do feel like it's a pretty unique environment. And when we saw the breakout to new highs, of course, that changed things and warranted a more bullish outlook.
In June, when did it?
That was actually mid-April, believe it or not. So that was above the 7,000 threshold. The S&P saw a pretty immediate and strong upside follow through after that breakout. And breakouts have been working in this environment. So whenever we see them, we actually have one right now in the industrial sector. We believe in those breakouts, and whether they make sense or not, really from a fundamental perspective, perhaps, or whether or not they're concentrated in one group, which of course has been the case here. And that's become really acute lately. And I think this week we've seen how the impact can be on a day-to-day basis. And what's happened with that is that with that sort of, I guess, chink in the armor of the AI trade, we have now a consolidation phase that shows a tug of war. People don't really know what to do with it.
I mean, there are people that maybe don't only do technicals that say we got to 7,500 so fast that's a pretty good number for the year in terms of a gain, isn't it? I mean, are we going above 8,000 this year?
The 7,500 level, believe it or not, was a measured move projection from the breakout back in 2025. we had thought it would be more relevant for 2027, and it goes to show how quickly things have unfolded. It's that same time compression, and it is definitely driven by the AI trade. So as soon as that confidence is shaken, we're seeing it in Korea right now. We probably have a severe retracement, but what we've been doing to respect the momentum behind the market is referring to the 20-day moving averages, a super simple way for people to watch momentum. And they have rolled over for the major indices, so that supports consolidation. They have not rolled over for the likes of Micron and that complex. So for those that own those stocks, while we might be hedged from a top-down perspective partially, we would still want to own what's working in the market.
And in your gut, do you think we have a six handle again anytime soon?
You know, the 7,000 support is pretty strong, but we have a neutral bias effectively through the year, just for the reason that we have the uptrend showing less momentum versus 24 and 25. That's measurable. And also we have some DeMark signals on the monthly chart that would suggest that things are overdone to some degree. These are not confirmed nor, I guess, pressing sell signals in the near term, but they do suggest that we'll probably get into something that's more range-bound. And the macro influences, they've gotten very, very interesting as well. I mean, with gold's corrective phase, I think we're starting to see a shift on the sector front. Equal weight is starting to outperform market cap weight. You look at the ratio of the Mag 7 to the S&P 500, it looks like a giant head and shoulders formation. So there's definitely been a shift that's made it a lot harder, I think, for investors to take advantage of the market.
So gold goes, is gold looking for a bottom here? I mean, that's consolidating some pretty big gains. And then oil, is oil headed to the low 60s?
These are major extremes that we're seeing from the commodities. And the gold downdraft is into some support. It shows signs of short-term downside exhaustion, but not long-term. We have a pretty significant loss of long-term upside momentum behind gold, as we've already seen. And with that, we do think that it's either range-bound here, but that doesn't preclude a relief rally that we can take advantage of, or perhaps a downtrend channel is unfolding. But I think the next leg for gold is higher. And of course, that would implicate perhaps that we're getting into a bit more of a defensive tape. Crude oil has taken out a couple key support levels, but there's additional support around $68 per barrel. That's based on our cloud model, which does hold relevance for crude oil prices. And we have oversold readings. We don't have an oversold buy signal yet, but our long-term indicators would suggest that we see a higher low in the high 60s.
So we're not going to pre-war levels anytime soon?
I don't think so, not based on the shift that we saw. And that shift, mind you, occurred before the war. So this was a shift that was already underway starting in February.
We didn't talk about bonds. I don't know. We won't talk about them.
Well, it is interesting. Credit spreads have come into support.
10-year, what's the 10-year?
Listen, that uptrend in yields does seem to be in jeopardy here. We've seen the 10-year yields take out their 50-day moving average, which is something to watch. It's a little bit early to suggest that's a reversal. Resistance is around 4 3/4, so an easy number to remember. Above that, then we start talking about 5 1/4 as being very realistic. So that's a key threshold for us. But I think we should all be watching credit spreads because from a technical perspective, they're on support and showing some signs of downside exhaustion. And that would suggest that maybe sentiment is shifting here.